NVIDIA just dropped what might be one of the most extraordinary earnings reports in tech history. The numbers are just staggering. But here's the thing. While all the headlines were screaming about record profits, Wall Street's reaction was kind of just a shrug. So what gives? Well, it turns out if you dig deep into the financial statements, there are a few key details that the pros are laser focused on. Okay, let's get into it.
First, let's just admire the headline numbers, because honestly, they're nuts. NVIDIA brought in a record-breaking $68.1 billion in revenue for one quarter. I mean, to give you some perspective, that is a 73% jump from just last year. On the surface, this looks like a company that is absolutely unstoppable, the engine powering this entire AI revolution.
But this is where things start to get a little weird and where the real financial detectives start paying attention. So companies have two ways of reporting profit. You've got the official GAAP number, which follows all the strict official accounting rules. And then you have the adjusted non-GAAP number. Think of that as the company's curated version, where they exclude certain costs to, usually make their performance look even better. Normally, that adjusted number is higher. But look at this. For NVIDIA, the official, stricter number was $3.4 billion higher. That's the exact opposite of what you'd expect to see. And for an analyst, that is an immediate red flag.
So yeah, what is going on here? What caused this strange flip? This isn't just some boring accounting detail. This gets right to the very quality of the earnings beat that everybody was so excited about. And analysts had to dig deep into the filings to get the real answer.
And here it is, buried deep in the financial tables. A massive one-time adjustment of over $5.4 billion, vaguely labeled as other. Now, this isn't profit from selling more chips. Nope. This is likely a one-off gain, maybe from a tax benefit or a revaluation of an investment. And this single line item artificially pumped up their earnings per share by 22 cents. That is a huge boost that has nothing to do with their core day-to-day business.
So let's just be crystal clear about what this means. A huge chunk of that profit that made all the headlines wasn't from NVIDIA's amazing business of selling AI hardware. It was basically a one-time accounting windfall. And for professional investors who care about sustainable, repeatable profits, this is what's known as a much lower quality of earnings.
But that's not the only accounting story going on here. There is another major change coming down the pipeline that Wall Street is watching like a hawk. Starting next quarter, NVIDIA is changing how it reports profits, and it's actually going to make their numbers look worse.
You see, for years, like most big tech companies, NVIDIA has excluded the cost of stock-based compensation from its main non-GAAP profit figures. Now, this is a very real cost, paying your employees with valuable stock, but by leaving it out, it makes your profitability look a lot higher than it really is. Well, that's all changing. Starting next quarter, NVIDIA is going to have to include this very real cost in their main adjusted profit numbers, and the impact is pretty big. It's going to instantly add about $1.9 billion in costs every single quarter. This not only lowers their reported profit, but it also makes it much harder to show that incredible year-over-year growth that investors absolutely love to see.
Okay, so that's the accounting deep dive, but let's get back to the actual business. What's really driving this incredible growth? Where is the money really coming from inside this AI factory?
This slide really says it all, doesn't it? Just look at this breakdown. Data center now makes up a staggering 91.5% of all revenue. Let's just be clear, NVIDIA is not a gaming company anymore that also does AI. It is, for all intents and purposes, purely an AI infrastructure company.
And if we break down that data center business, the story gets even more interesting. While the compute part, the GPUs themselves, grew an impressive 58%, look at networking. It surged an unbelievable 263%. This shows NVIDIA's grand strategy is working perfectly. They're not just selling you the chips anymore, they're selling you the entire high-speed system that connects them all together, and they're capturing a much bigger piece of the pie. But here is a fascinating little twist. The single fastest growing part of their business wasn't even in the data center. It was professional visualization, which shot up 159%. And this growth is coming from a rising demand for super powerful workstations. As companies worry more about data privacy and want faster results, they're buying hardware to run AI models locally, right on the desktop. It's a small but really important part of the bigger AI story. However, we have to talk about the massive elephant in the room: China. Because of U.S. export restrictions, NVIDIA's forecast for the next quarter assumes they'll make exactly zero revenue from data centers in China. This used to be a market worth around $8 billion a year. Now, so far, demand from the rest of the world has been so insane it's more than made up for it, but that remains a huge geopolitical headwind.
So you've got this incredible picture, right? Record-breaking numbers, explosive growth, and guidance that looks fantastic even after completely writing off China. The stock should have just blasted off to the moon, right? Well, let's see what the market, the ultimate decider, actually had to say about all of it.
This analyst quote just sums up the whole situation perfectly. When a company delivers absolutely amazing news and the stock just kind of goes nowhere, it's a major warning sign for professional traders. It suggests that the stock's super high price already reflects all the good news, and maybe even a little more. There's just nobody left to buy and push it any higher.
And this slide shows exactly what chart analysts are getting so worried about. They see this rounded top pattern forming, which they believe is a visual sign of something called distribution. Basically, it means the big players, the whales, are quietly selling their massive positions to the smaller fish, the retail investors who are excitedly buying based on all those positive headlines.
So all of this brings us, the investor, to a crossroads. You've got these incredible fundamentals on one hand, but on the other, you've got these concerning technicals and some weird accounting details. So what are the key things to actually watch from here on out?
So here's the action plan analysts are looking at. First, keep a really close eye on that floor. The $180 level is the 50-day moving average, a key technical support level. If the stock breaks below that, it could confirm that whole rounded top pattern. Second, you have to fight the fear of missing out. The market just shrugging off a perfect report is a classic warning sign. And third, watch for rotation. Keep an eye out for signs that big money is quietly selling chip stocks and moving into different sectors of the economy.
Looking ahead, two very different paths are emerging. The bull case is that the new Blackwell chips ramp up perfectly, and demand from sovereign AI, we're talking entire nations building their own infrastructure, keeps this growth engine roaring, potentially pushing the stock up towards $230. The bear case is that real-world problems like power shortages or a pullback in spending from unprofitable AI startups create a demand vacuum, triggering a big valuation reset down toward that $150 zone.
In the end, it all comes down to this one question. There is absolutely no doubt that NVIDIA is the foundational company of the AI era. They are the chief architect of this new industrial revolution. But after a truly historic run, the big debate on Wall Street right now is whether the stock's price has finally gotten ahead of even its own incredible reality.